Welcome, everyone. My name is Amit Pandey. I'm here in Tucson, Arizona. I'm a realtor with eXp Realty, and I'm here with Derek Polder, who's a senior loan officer with Cross Country Mortgage. We're both in Tucson, but we work in a lot of different places. So I'll let Derek introduce himself real quick, and then we're happy to present to you on some basics of home ownership. And we have a presentation. We want to keep it to an hour, but we really want this to be more of an informal. We don't want it to feel like, like a lecture for you all. So I'll be monitoring the chat. And if you have any questions on anything, Derek's going to be doing a lot of the talking on the slideshow, and I'll interject here and there, but I'll monitor the chat. And if there's any questions, I'll share it with the group and we can field those questions. And then obviously, if we run out of time, you can feel free to reach out to us and follow up on anything after the presentation. We do want to be mindful of the 1 hour time here. So Derek, do you want to introduce yourself real quick?
Yeah, absolutely. So thank you guys for attending today. My name is Derek Polder. I've been doing loans for over 15 years. I actually started right before the 08 crash. So I've seen all different types of housing markets. I've seen what they say is one of America's worst housing markets. And then obviously coming out of the last couple of years, I've seen the hottest markets. And so I hope to bring you practical insight and information, knowing exactly where to take advantage of programs, things that you may not be aware of in terms of financial or economic benefits for yourself, and then some real life examples of do's or don'ts. This is going to be a very hands-on lecture by Amit and myself that come from deep experience. Amit's a guy who's not only represented clients as a realtor, but has also built his own investment portfolio. So I like to teach with him. I think that we get a good, well-rounded perspective for you. And I'm very passionate about the topic of homeownership. Yes, that's a reason why I do mortgages for a living, but I'll share with you one of my own personal stories before I even got into mortgage. So I bought my first home prior to 2008. I want to say it was probably 2005. I think I purchased the home, and I bought that house for $157,000. And my timing was a little off, because that was right before the market peaked in 06, followed by a very steep crash that happened in 08. And even with that being said, in terms of timing, let me find, I'll show you the math on that particular transaction. What I'm very passionate about with real estate is it's one of the few investments that once you have it set up, even if your timing is not perfect of the market, if you set it up right, and you understand how to protect yourself on potential downside or retracting markets, it's, in my opinion, the best tool that you have for economic prosperity of anything else that's available to you in the U.S. And I'll share with you the example of my house. So I purchased my house doing a loan for low down payment, something that's really geared towards first-time home buyers. It's a federally insured mortgage. And when I bought my house for $157,000, I had to put down 3.5%. So that was a down payment of $5,495. Now, just a few short years after buying that house, my value crashed all the way down to about $110,000. So I was into it for that 157. It dropped down to, I think, like 112-ish range. And so I had lost $45,000 in home equity in just a couple of years in what was called the Great Recession. I had no idea that was going to happen when I bought it. And so I'm thinking a couple of years into that, I'm like, gosh, I really made a mistake. I bought this house and I'm stuck with this thing. And I remember asking a friend, I said, should I sell this house? Should I do a short sale? Maybe this was a really bad idea. And his question to me was, how's your income? And I said, well, I'm making the same as I was making when I bought the house. He said, okay, so you can afford the payment. I said, yes, I can. He says, Derek, every asset has cycles. Never sell an asset in a down cycle. Just, focus on what you can control, which is your income, your job, and real estate will have its cycle too. Interesting enough, I held on to that house. 2-3 years later, I had to move out of it. I outgrew it, wanted to get a different property. So I ended up renting that house out. I didn't make any money. I made just enough rent to cover my mortgage payment, and that was it. And I did that for a couple years. And I sold the house about 2-3 years ago, probably a little bit early, probably a year too soon. But I sold it for $197,000. And it cost me about I had to pay 6% to real estate agents, and I had to pay 2 or 3% in closing costs. So we'll just say it cost me 9% to sell it. So times 0.91. So I was left with a net of 179,000. And again, remember, I bought the house for originally 157. So my spread was $22,000 that I made off of a $5,450 investment, which means that I made 408% of my money. And that was over a period of, I think, 7 or 8 years. So let's take 408 divided by 8. That means that even in the worst timing, I bought real estate at the worst time, right before the 08 crash. But I was able to make, I was able to be in a payment that even in a housing crash, I gave it time, almost 10 years for, the market to go through its cycle. Even I had to move out of the house and move into another house to go with my family increasing needs. I still made 51% annualized rate of return on my down payment. And I own that asset where I was able years later to sell it and make $22,000 of net profit on my money. And only real estate can you do that. And there's another slide in here which we'll share, but you can research this fact for yourself. The average net worth of a homeowner in America versus a renter, just those two distinct differences, renting versus owning. Amit, do you have any idea in multiples what the multiple is of a homeowner versus a renter?
You showed this to me last time. I mean, is it over 10 times? I can't remember.
Over 40 times.
Yeah.
So a homeowner has a net worth that's over 40 times greater than a renter. If we're going to put that into dollars, the average renter in America has a net worth of $6,300. The average homeowner in America has a net worth of over $240,000. So it just goes to show you real estate is special because everyone needs food and shelter. You're going to pay a mortgage. You're either going to pay a landlord's mortgage or your own. And when you set up real estate, it grows on the leverage of the investment. So my 5,000 didn't grow off the 5,000 like it would if I was buying stocks or 401k. I only get to grow off the 5 grand. That 5 grand allowed me to own a house worth 157,000, and it grew on the asset value of the whole house and not my little $5,000 down payment. So this is why I'm so passionate about teaching people about real estate and the pros and cons and how it works, is because there's no greater tool to change your financial life than homeownership, in my opinion. So with that, we'll go ahead and jump into the basics. Again, this is meant to be very entry level, what you need to know. And if you have more questions, Amit's an expert at all things related to contract negotiations, house hunting, and all that. And I will help you on the financing side with questions that you might have. My company is licensed in all 50 states. We're one of the fastest growing mortgage lenders in the US at Cross Country Mortgage. We're number 3 in the United States right now. So in any state that you're looking to buy, we can help you. I'm not licensed in all states, but I can certainly introduce you to a team member that would take care of you. All right. So with that being said, let's go ahead and jump into it. So in terms of, homeownership is based on finances and where you're at financially. So, a couple of things to think about, what are you here for today? What's important to you? These will help you formulate the questions that you need to ask to Amit and I. Where do you want to be financially in the next 5 years? What's stopping you to getting there? Where are you not right now? Do you have an idea of your savings? Are you pretty clear on your income that you're bringing in? How much free cash flow do you have? How much can you save per month or per year? How much debt do you have? Those are all things that it's good to periodically stop and analyze and make sure that you can answer those questions.
Then Derek, before you move on from this slide, we just want to be cognizant because we know we're presenting to a large population that's still in school right now. So, usually when we get this presentation, it's, first time buyers, their full-time jobs. So, none of this is meant to say that, we want you to, obviously if you can buy a house soon, great, but we want to just be able to plant these seeds in your head. So some of you guys, you might be years from graduating from your graduate program. So, homeownership might not happen immediately, but at least we can give you some basics and some principles. You can understand some of the vocabulary, some of the real estate landscape, and then you can start planning, like, if this is my goal, what can I do in the next 2-3 years while I'm in school to position myself? Because there are things you can do like, for example, like building your credit score. And those are things Derek will talk about. And then when you're able to get that full-time job, or when you're in a position where you feel comfortable to buy, then you'll feel much more empowered. So we just want to keep that in mind. We do realize that, a lot of you are still in school, but some of the principles that we're going to give you, or all the principles that we're going to give you, are going to be applicable, whether you're ready to buy like this year, or whether you're going to buy in a couple of years down the road.
Yeah, and to piggyback on that point, I don't think it's ever too soon to get this information, because there's a lot that you can do to plan for homeownership that will save you a lot of money, that can make your payment more affordable. So it's never too early to say, what does it look like for me to buy a house in my market? And I think that's a great experience to go through. It would take usually about 30 minutes for us to analyze credit, income, et cetera, to tell you what you qualify for. And that way you can, if you're in school, that gives you a good idea. If I want to buy a median home in my market, when I get out of school, what type of income do I have to earn to actually be able to afford a home in this market? And I will tell you, there's a lot of things that you'll read online or that you'll see on the news, and it's off because they're trying to give you an answer that fits the general public. And everyone's situation is so uniquely different based on credit score, personal debt, and then of course the income on the job that they're at. So to Amit's point, you might still be in school, still is going to be great information you can take with you. And again, it's never too early to learn this. So I talked about wealth. The easy summary to this slide is there's a lot of different ways that you can make money. Family money, business, getting lucky on crypto, but something that's tried and true is real estate. I just showed you the math behind it. So real estate is tangible. You can impact it with a paintbrush. You can impact it by, selecting the location and knowing that there's, up and coming things being invested in a city, and you can make smart decisions that greatly increase the value of real estate versus, you buy stock in a company and they could be out of business, the next day. So there's a little bit of a gamble there. So I think we've already touched on this. We are people that this is our practice. It's what we do every day. I've personally worked with thousands of families. Amit comes from education. He's been a very professional realtor. He's also built his own investment portfolio. He's familiar with house hacking strategies and all that. So you're learning from people that, aren't just teaching you something out of a book as an idea, but we're also sharing real life experience that goes along with it. All right, I talked about this slide earlier, but this gives you the visual. 82% of Americans have no ability to retire. 1 in 3 has saved zero for retirement. And one of the biggest saving graces for people is owning real estate. Again, that's a stat pulled right off the Federal Reserve. You can research it yourself. Just Google what is the net worth of a homeowner versus a renter, and you'll find several data points that support that. Now, this is an example in our market. You can get a house around 300 to 350,000. So I wanted to show you yet another example of cash on cash return. I gave you my story of buying, before the 2008 crash, but let's just look at very conservative numbers. If you bought a house at 300,000, your minimum required down payment as a first-time home buyer is 3%. You might even have a lesser option. You could maybe even do 2.25 or 2.5 if you qualify for the HUD 184 loan. But typically you're looking at right around 3%, give or take. If real estate only grew 2% in value, which over the last 3 years, it's grown over 50%, and that's a fluke. That was low rates because of COVID. But if you look historically, real estate has generated almost a 4% return in nearly 100 years. In the last 60 years, it's been nearly a 6% annualized rate of return. So I'm going to take that off the table and say, you know what, we've had such a huge run up with home values. Let's go really conservative and say real estate just stays on pace with inflation at 2%. So if real estate only grew 2% per year, over 5 years, it would grow 10% in value. So if I bought a house at 3% for 3% down, that would be $9,000. If my $300,000 house grew 10%, it would grow by 30,000. That's 330,000. That means I made 30,000 off of 9, which is a 333% return on my cash, which is 66% per year. To give you an idea, the best, a hedge fund manager, so Wall Street's brightest minds are trying to beat the S&P 500. And the S&P 500 usually averages around 10%, give or take. And most firms, guys that get paid millions of dollars, will not beat the S&P 500. They will not beat the return of the 500 biggest companies in America. Most multi-millionaire hedge funds will not beat them. Warren Buffett made a bet with a very smart trader friend of his that the S&P would outperform his best handpicked fund managers. He bet him $1 million. I think the guy was able to pick 5 firms, and not a single one of the 5 beat the S&P, and his friend was able to win that $1 million. Warren Buffett won that bet. So here you have simple homeownership making 6 times what the S&P 500 is making annualized, and with also real collateral that you can hold. It's not a piece of paper that says you own stock that you hope the company will be there tomorrow. It's a house that you can fix up, that you can paint, that you can customize, that you can actually truly impact the value. So in terms of the market, there is a lot of questions about, well, I heard interest rates are higher, and just a couple of years ago, my friend bought a house, or my parents bought a house, or my sister bought a house, and they got a rate of 3%. How does that compare to today? And what I will tell you is it's 2 different markets. When rates were 3%, the benefit of buying a house then is the 3% interest rate. So you got a lower mortgage payment. The downside of that market was everyone was competing because money was so cheap that what you ended up doing is you had to pay you had to bid up against other buyers. You were competing against other people that were pre-approved at a 3% rate. And so instead of buying that house at $300,000, you might have bought it at $330,000 because there was a bidding war. And then you said, I'm going to pay my own closing cost, pick my offer. Don't pick Amit's offer. I'll pay my own closing cost. And I know the house has a little bit of painting that's needed. Don't even worry about the painting. I'll paint it myself. I'm okay with the roof being in bad shape. You kind of just settled to get a house because of how competitive it was. And so what that did is you got low rates, but your cash to buy the house was much higher because of all these additional expenses that we just talked about. The market today, rates are up, which means the payment's up. But what's happened is you've had prices pull back a bit, and Amit can cover this more about closing costs and how that works. But basically, it's usually costs about 2 or 3% of whatever the home price is in closing cost. And so more realtors are able to negotiate that money, which is a direct savings for you. It means that you get to keep thousands of dollars more in your pocket, and you get to ask them to fix the roof, and you get to ask them to repaint the house. I mean, it's all subject to the negotiation, but that's a situation where today you can get the closing cost credit, you can get the credit from the seller. And so if you're saving that, all that money goes right back in your pocket, where I'll see, 20, 30, 40% less expensive to buy today than it was at the peak of the market a year or two. So Amit, do you want to touch on that a little bit with concessions?
Yeah. So a lot of buyers, and some of these scenarios we've shown here are like, they're the idea is accurate, but there's some fine tuning. So when you buy a house, you don't just have a down payment. Your down payment is how much you have to put down towards the loan to get the house, but you also have closing costs. And like Derek said, this can be another couple of % of the purchase price. What are closing costs? These are things like when you close, you usually close at a title company. So the title company has their fees. There's title insurance. The lender has their fees. The lender typically also collects what's called some prepaid. So they'll collect some number of months of home insurance and property taxes in advance to create an escrow fund. So these are, and then you have the appraisal on the property itself that the bank requires. So if you want to talk a little bit more about closing costs, we can do so. Afterwards, I'd be happy to talk to you. But just to give you an idea, that does add up, and it does add up to several thousand more dollars. So this is something that you can negotiate with the seller. But like Derek said, in the last couple of years, when the market was so competitive, you'd be crazy to ask the seller to give you any type of concession, whether it was a reduction in purchase price or closing costs. Now, what we're seeing, and some of the really smart listing agents here in town are already offering this up front without even having to have the buyer ask for it, is they'll say, this is the range of prices we'll accept. Like, let's say it's $340,000 to $350,000. So they said, we'll take $340,000 to $350,000. You can offer that much. If you need some concessions to help you cover those title fees, Another thing that Derek can talk about is some of these closing cost concessions can be used to buy your rate down. So you can actually use some of that to either do a permanent or temporary rate buy down. And that's something that Derek's very knowledgeable about. But you can use some of those concessions that you get to put it towards that. So some of the really smart listing agents right now, they know that it's hard to, it's less affordable to buy a house right now. So let's build that into the price up front. So there's no like back and forth guessing. They'll say, we'll price this home from anywhere from 340 to 350. Hey, if you don't need any closing costs, if you're just going to bring cash, give us 340. If you're going to need some assistance to save that money up front, whether you do a rate buy down or save some money, then offer a little bit on the higher end towards 350. And then you can use that money, work with a smart lender and figure out what's the best way to use the extra $5,000 or $10,000 to get the interest rate that you need to be able to make that payment affordable. So Derek, did that kind of cover a little bit about?
Yeah, 100%. So when you're looking at that, this visual gives you an easy way to follow that the down payment, that's what you have to bring in as the client, that 3% give or take number. But then you're going to have your closing costs. You might have the repairs. So these are things that a good agent like Amit can negotiate for you. So you only have to worry about your money down. Everything else may be able to be covered depending on the negotiation. And to his point, that could be thousands of dollars. The biggest risk that I see when rates come back down, which will probably happen this year or next year, when rates do decrease, which the reason I say that they will come back down is because Fannie Mae is predicting that interest rates are going to come down. Goldman Sachs is predicting that interest rates are going to come down. And the reason for that is it always happens. The Fed goes through a cycle where they raise rates. When money gets too cheap, they raise rates, which they've done. We've raised rates consecutively the last 8-9 meetings with the Fed, and that's going to slow down spending. That's going to cause some employers to lay off. We're already seeing that. Big employers like Google and Facebook laying off 10,000 people, and they're doing that because it was easy to hire when money was cheap. Now that money has went from 2 or 3% to 6, 7, 8, 9%, it's more expensive to do business, so companies cut back. Once that happens, and you see less spending and you see a softening in the economy, the Fed is going to balance it back out by cutting rates, which they always do. Every recession that we go into, we've always slashed interest rates. And that's going to then be the key for more people to want to buy real estate. But we have not built enough homes. We have a huge inventory shortage in this country. To give you an idea, in 2008, there was 4 million homes available on the U.S. housing market. This year, there's just under 1 million. There's about 980,000 in the last month's data that was released. Of that, over 300,000 are already under contract. So there's about 620,000 homes available in the U.S. And we have 14 million more households that are age 27 to 35, which are the leading demographic of buying real estate. 14 million more people that are going to compete for greater than 3 million fewer homes. And so when rates drop and more of those buyers go into the marketplace, there will be that competition where it then gets more expensive to buy. So if anyone is in that position where they're thinking about, do I buy real estate now or do I wait? In my opinion, you're going to save yourself thousands of dollars by buying now, negotiating all of your closing costs or as much as you can get, and then just taking advantage of refinancing it when rates come down because you'll already own the house versus going into the market and competing against other buyers because we just do not have enough homes. As a country, we cannot build enough homes to keep up with the growing population in a short period of time. So it will be out of pocket more expensive to buy a house when you're competing against more buyers. So just keep that in mind.
And then just to piggyback off that real quick, and then we'll move on. So, when you're buying a house, there's 2 factors to consider. So there's the acquisition price, that's how much you're getting the home for. And then there's the affordability. So in the last couple of years, the affordability was really good because the rates were so low. But as a trade-off, the acquisition price was sometimes much more expensive, like Derek just mentioned. I have a lot of friends who bought homes in the $300,000 range where they had to go 20, 30K over ask. And that was money that was coming out of their pocket because the home wouldn't appraise that high. So they had to be willing to cover that extra, however much they were willing to go out of pocket. They couldn't finance it because the lender sent an appraiser out and the appraiser didn't deem that it was worth 330 when it was originally listed at 300. So for them, their acquisition price was high. even though the affordability was good. But once you have that high acquisition price, you can't control that, right? Once you've committed to paying 330 for that house, you can never change that number. Whereas right now, affordability is a little bit harder, but like Derek said, you can refinance, you can control that. And all the predictions are saying that within the next year or two, rates are going to drop. So right now, the acquisition price is a little bit better, even though affordability is a little bit tougher. But you can control affordability. You can't directly control it, but when rates go down, you can refinance it, and you have a lower, you have a more reasonable purchase price right now. So the equation's kind of flipped a little bit. And if you understand how to refinance smart, and again, right now, there's a lot of relief you can get through these temporary rate buy down programs where, we're getting people that are getting, Derek, if someone does like a temporary 2-1 rate buy down, what kind of interest rate can they get in the first year while they're waiting for rates to drop?
Yeah, and I think that's where there's, really looking at your scenario and getting, the one-off answers to your questions will help a ton. But to give you kind of a rough idea based on a $400,000 sales price, I mean, you're looking at knocking off $400 on a monthly payment. So there's a lot of things that we can do to help with the monthly payment. As Amit just mentioned, the market's helping with the total cash to close. So it will cost you thousands of dollars less to buy in a slower market. But with rates up, you're going to pay hundreds of dollars more, a couple $100 more on your payment. But there are ways that you can erase that when you're working with a good realtor. And for that one-off scenario, that's where you talk to Amit directly about, hey, it costs X amount to buy in this market. What would be strategies that you'd recommend? So,
and then Derek, we have some questions in the chat, and some of these will probably wait till the end because otherwise it's going to throw the flow off. But someone is asking about refinancing, and so for you, Derek, they're saying, is it hard to refinance when your credit isn't great? So I know that doesn't really fit in exactly where we're at right now.
But great question. So the idea is, in order to buy a house, the lender that you're working with is going to give you a plan to purchase the home. And the requirements it takes to buy a house are the same to refinance a house. So if the program that I qualify you for, if I say, hey, we need to get your credit score to a 600 or a 640 or whatever the requirement is, if rates drop a year later, that's going to be the same requirement to refinance. So the idea is, if you kept the same credit, the same job, it wouldn't be challenging because we already got you the loan to buy the house. So it should be just as easy to rewrite that loan at a lower interest rate. So refinancing is not hard if you qualified for the purchase.
Yep. And then we did have some more questions, but I just want to make sure those people don't think that we're ignoring them. We'll wait till the end just because they don't really fit in the flow, but they are good questions, and I do see them, and we will get those answered.
All right, perfect. So let's talk about, what are these things that keep people out of buying a house? I think the biggest myths are, even the real estate experts on TV, I can't believe how many times they tell people you need to have a 700 credit score and 20% down. That's inaccurate. The federal government has actually done so many things to make homeownership very attainable. In fact, one of the biggest reasons why the government got so aggressive in helping lower the bar to homeownership is because of the Great Depression. When the Great Depression happened, out of all the things the federal government could have done to stimulate the economy, their number one bullet was real estate. And why is that? Because so many things come off of real estate. Plumbers get jobs, roofers get jobs, interior designers get jobs, a furniture store guy, people that sell cups and plates and spoons and, rugs. I mean, you name it, there's all that stuff that people want to put into their home or the work they need done on their home. And so there's a lot of retailers and contractors and so forth that go to work. So the government said, well, if we look at this, we have a very low homeownership rate. In some communities, it was as low as 1 out of 10 households. The national average was 4 out of 10. And so when the government looked at why was it so low, what they learned was the biggest barrier was the down payment. Banks usually wanted 50% down. They wanted you to pay off the loan in 3 to 5 years. And most people did not have that money or make that money to be able to do that. So the government said, well, let's figure out how to solve that problem. And they created a federal insurance fund where they said, hey, as a bank, if you give more people mortgages, if you only require little down payments and something goes wrong, we will write you a check as the bank to make up the losses in the event that you gave Derek a loan. He only put down 3%. and he didn't carry his end of the bargain. Maybe he lost his job, or maybe he was struck by a bus. He just, he's no longer here to make the payments. In that case, because the bank gave Derek a mortgage with such a little amount down, the bank would go out of business with that business model, because they would have to wait until they took the house back, which takes several months to go through a legal process. Meanwhile, there's no one paying on the debt, so they just have the money sitting there against that house. And then they have to fix up the house to take it back on the market to sell. And then they're gonna have to pay the buyer's closing cost. So, the bank has meanwhile not collected a payment on their loan for 6 months, and they had to put thousands of dollars more into the house to sell it. They can't run that business model with 3% down payments. So what the government offered the banks is they said, we will create an insurance model that Derek will pay a small part of his payment will go towards this insurance. And if Derek is struck by a bolt of lightning, then as the bank, you can cash out this insurance policy. It's good for Derek because he gets into a house with less money down. It's good for you as the bank because in something that is unforeseen happens, your bank's not going to go out of business. And what that did is it created, from 4 out of 10 households owning real estate during the Great Depression, it went as high as 7 out of 10 after World War II. And now our national average sits around 6 to 6.5 out of 10. So it's really worked. And that's with as little as 3% down, you can now buy real estate. And again, if you're Native American and you qualify for the HUD 184 loan, you can also qualify for as little as 2.25 down. It's a even better version of that program to allow you to get into a house with lesser money down. The other scenario that we have is just a lot of misinformation. People think they need to have perfect credit. They're unaware of that 3% that you need. There's many state and federal programs that will actually give you the full 3%. So you can, there's been many times, Amit, have you ever worked with a client who got into a house with literally no money down?
I have. So I worked, I didn't introduce this part of me in my introduction, but I lived in Gallup, New Mexico for about 10 years. And Gallup is in a rural area, and there's actually a USDA loan that's a zero money down. That's not a grant, it's just another loan program, but it allows for a buyer to get in with zero money down. Now here in Pima County and in Arizona, there's also some grant programs. So I mean, Tucson is not rural, but there are grant programs here that offer down payment assistance that after some number of years, it becomes forgivable as long as you live in the house. So there's some great programs like that. So I have worked, in fact, the last home I closed, my first-time buyer used what was called a mortgage credit certificate. That's a program that's available in Arizona that basically gives first-time buyers who make under a certain amount of income a $2,000 a year tax credit, which basically they can use to help them with their mortgage payments. So lots of great programs. I know there's some in New Mexico. There's a lot here in Arizona, especially in Pima County. So again, that's something that we'd be happy to, because we know that not everyone's in those 2 states, but we can, many states have really good programs.
Yeah.
And then,
So,
sorry, in the comments here, so we have, Derek, you had talked about Section 184. We have a question. Can you refinance a HUD 184 loan in the same manner as a regular loan? Do you happen to know that?
say it one more time.
Can you refinance a HUD 184 loan in the same manner as a regular loan?
100%. Yep. The rule is on the HUD insured loans, you have to make 6 payments before they're eligible for a refinance. So after 6 payments, you're eligible to do a refinance.
Okay. And then one more question. Can you use multiple loan programs together?
Yes and no. So think of the loan program as the vehicle. So I can only get in one vehicle. I'm going to do a 184 loan, but then there's add-ons, there's additional products. So I can do a loan program like 184, but then maybe we see this a lot with various tribes that offer down payment assistance. So there might be a tribe that says, hey, we give $10,000 towards any member of our tribe that wants to buy a house. So they could do a 184 loan and combine it with tribal assistance, or you can do a 184 loan and maybe there's a county program that's giving, the minimum down. So you can combine that with the county program, but I can't do an FHA loan and a VA loan at the same time because that's the vehicle, but I can use the vehicle and then add on these customizations, which is usually in the term of interest rate or down payment or both. Right.
And then my understanding, Derek, is some of these down payment assistance programs, like, they're going to help you with, the 5% down or whatever. That is it true that those are like second loans that are like kind of like silent loans that are forgiven after some number of years?
In most cases, yeah. So if you are going to use a county program, usually what the county does or the nonprofit will do is they will record what's called a silent second. So if I'm buying a house, I'll just use easy math. I'm buying a $100,000 house and they're going to give me my 5%, which is $5,000. They're going to record it. They're going to say, you don't have to pay anything on this. It's basically free money, but we don't want you to buy a house to turn around and sell it 2 years later. We're doing this to give you a roof over your head to encourage home ownership. So we're going to put a 5-year silent second on this. So we're going to record on your title that you owe us $5,000 to the, to City of Tucson or Pima County in the event that you sell in the next 5 years. After 5 years, we forgive it. If you sell it on year 7, that was your free $5,000. So there's a lot of programs like that they will encourage you to get into the home. They don't want you to flip it for a quick profit. And so they'll record an IOU in the event that you sell early.
Okay. And we do have several questions about, will you provide us that information for Arizona and New Mexico? So what you guys can do is, if you're interested in those programs, we have our contact information at the end. Please email us. And then depending on where you are, because these programs vary, some are statewide and some are county. So if you can tell us where you are, we can definitely get you connected with those programs.
Yeah. So, the easy summary for this is, because the US economy is so vested in strong home ownership, they've really made a wide box of who qualifies for a mortgage. People get shocked a lot, but FHA, for example, will go all the way down to a 500 credit score if you have 10% down. And if you don't have 10% down, they will go to a 580 score with 3.5% down. They will allow you to have medical collections. They'll even allow you to have old collections as long as it's not over $1,000. If it's over $1,000, they just want to see that you could handle in a payment plan. So my point being is, so many people feel like I have to have this perfect credit score. I have to have a large amount of money down, and it's just not the case. That's why I say it's never too early to talk to an expert that says, here's where you are today. This is what it's going to take for you to get into a home tomorrow. Sometimes that plan is, 10 steps. Sometimes that same phone call, you realize, wow, I could buy a house today if I wanted to. And Amit, I would tell you, I've lost count over the years of how many people made a phone call to us to think that they were going to get information like, oh, I figured I have to do a lot. And they're hanging up going, I had no idea that I'd be able to buy a house today, and my payment would actually be less than I'm paying in rent. So that's why I say, don't put your head in the sand, at least get the information as early as possible. So that way you're not holding yourself out of homeownership based on an idea in your head that has not been validated by a professional.
Absolutely. And then we had Derek, one more question before we move on.
Yeah.
What are options for someone who's working with credit consolidation? Now, I know you guys do a lot of credit counseling as, part of the loan application. What can you say about that?
So say it one more time about the credit counseling.
What are some options for someone who has credit consolidation?
Yeah. So consolidation is a funny thing, because there are companies that will do it for you. And the worst case scenario I've seen is that they are unsuccessful. So when you do a consolidation, they're going to tell you to stop paying on your 5 credit cards and just pay us. So, hey, maybe you're paying $100 a month to 5 people. And they're saying, hey, instead of spending $500 a month, give us $200 a month, save $300, and we're going to go renegotiate with all 5 credit cards to accept the $200 a month. Until they reach an acceptable agreement, if it takes 12 months, your credit is destroyed for 12 months, because it's going to show late payments on all 5 of those accounts until 12 months later, when they all agree and say that's fine, and then they accept the payments, then your credit score gets fixed and repaired. But what happens if you went 12 months with only paying them, and one of those credit cards does not agree to the consolidation? Now you have a year of credit lates with that one company. And I've seen that happen. That's the worst case scenario. The best case scenario is, you're waiting for the 3 months, the 6 months, the 12 months it takes to reach a resolution before your credit's fixed again, that you can actually buy. So the simple answer would be, you want to make sure that they've reached an agreement, that it shows that your payment history is back on track. And then that's fine if you're in a consolidation plan. What I would tell you is, a lot of times you can do your own consolidation plan by calling the credit cards directly. That's all these companies are doing. And that way you don't ruin your score temporarily while you're making a new agreement. Credit card companies are incentivized to work with you. They actually get pressured by Congress to do that. If you're calling up and saying, hey, I need your help, what can you do? A lot of them will work out agreements or consolidation plans with you. All right, so there's a lot of different loan programs out there. These are the generic ones that fit most people. You have conventional, which is 3% down. If you do 20% down, you don't have mortgage insurance. And this actually just went up this year, so we need to update for 2023. Your conventional loan limits are now $726,000. So you can buy a lot of house using a conventional mortgage. FHA is 3.5% down. FHA is actually a sister program. So FHA has they're owned by HUD or managed by HUD, and HUD has a special carve out for Native Americans, which is actually lesser than the 3.5% down and less expensive. The mortgage insurance is lower. So you get a lower down payment and lower monthly payment with tribal status. And then if you've served the country and you're a veteran, you can do 0 down. And by the way, the FHA loan limit today is now $472,000 for Pima County. So USDA, if you're in a rural area, you can buy a house with 0 money down, even if you have not served your country. That's a great program. And then if you're buying a big house, like $1 million house, that's where you get into a whole different subset of programs. Now, as far as down payment, you might say, okay, well, what if I don't have the 3 or 5% down? To give you an example, in the market I live in, there's all these different programs that are available to help with down payment. There's a lot that's available in most marketplaces across the country, because just like the federal government realizes that the more people in a community, the more people in our country that owns real estate, the better for our country economically we all are. Cities and states realize the same thing. So you have cities and counties that also put programs out there to help you get the 3.5% or 3% or whatever it is that you need. We have a client right now that he's getting 10% through the home program, and then he's also bringing in $2,000 of his own money. This program called Wish will do a 3-to-1 match. So his $2,000 turns into $6,000. And there's some amazing things out there to help you get into homeownership.
So Derek, before we move on, since we're talking about loan programs, we've had a couple of questions in the chat asking about like basically a construction loan. So if someone wants to build their own house, I'm not sure if you guys do construction loans, but can you give like some basics on how that would work if someone has some land they want to build on it?
Yeah, so construction is there's 2 different answers to that. So one is, generally speaking, construction loans are going to require about 20% down. That's the general rule of thumb. Banks will be different, but state to state or whatnot. And if you own the land, that can count. So I'll use easy math. Let's just say, like, my dad gave me a lot. He bought land years ago, it kept it in the family and said, hey son, I want you to have this house, go build your dream house on it. And I decide that it's going to cost $80,000 to build the house that I want. I'm using very simple math for the example. The bank's going to say, okay, well, now you need to go find land. So go find the land to build your $80,000 house. And if I say, oh, I already have the land, my dad's giving me the land, and the land's worth $20,000, that would be 20%, right? So the land of $20,000, $80,000 to build, that's $100,000. But I already own the land. Dad gave it to me. It's free and clear. I don't have to put down any money then. The bank's going to give me $80,000. That's 80% loan to value. So I could essentially build my own dream house with no money out of my pocket because I already own the family land. So if you own the land already, construction loans are a really, really good way that you could, build a house without coming much out of pocket. If you don't own the land, they're going to take the cost of the land plus the cost of the construction. They're going to put the 2 together, and they're generally going to tell you that you need to put down 20%. And that's hard to do because you're gonna have to hire an architect up front, pay the architect $10,000, $20,000 to build your plans, to then tell you now you have those plans, to then find out it's gonna cost, $100,000 to build this house. So construction loans are really good if you own real estate already and you have a large down payment. Then you're gonna want to look at construction. Otherwise, your next best option is to go to a builder where you can buy new construction. Do you want to talk about that, Amit?
Yeah, so I mean, if you live in Albuquerque or in Tucson or in Phoenix, and you go like anywhere on the outskirts of town, you've probably noticed how many homes are being built because there's land out there. Derek's already mentioned what a huge shortage of inventory we have in terms of homes. So builders are, they're trying to do their part. They can't build them fast enough, because there's COVID really messed with supply chains, costs of a lot of things went up, but they're doing their best. And right now, is actually a very interesting time with new construction because they're offering a lot of incentives right now. So I got a couple homes under contract with new builders where they cut the price, like 10-15% off the list price, and they're throwing in all the appliances. So there's some good deals in new construction. And typically how that works is you put a deposit down, $3,000, $5,000, $10,000 down, and then the home might take up to a year to be built. So as it's being built, they'll send you updates. We just did the framing, now we're doing the drywall. You can have inspections done along the way to verify the build quality. And then the actual down payment, the rest of it would be due when the home is complete at the end. So there are some good opportunities in new construction right now. And Derek, going back, go ahead.
The biggest thing to emphasize on what you're saying there is when the builder builds it, that takes out the large down payment that you have to do. So to Amit's point, you just do a deposit. That deposit can be, a small percentage, 1 to 5%. And then the builder puts all the money up. They buy the land, they build the house, and then they give you the finished product. And you just have to worry about that down payment. So that's a way to get a new home semi-custom, because they let you pick, different finishes without the large down payments. That's one way to do. Another way to do a quote unquote like new custom or construction loan without the additional expense.
Okay. And then Derek, before we move on real quick, someone had mentioned that they're a contractor. So can you touch real quick on if someone is not a W-2 employee and they're like an independent contractor, they're on a 1099, how does that affect their loan qualification? Can you talk about?
Yeah. So if you're self-employed, so you're a contractor or 1099, then usually you need to be in business for 2 years. That's what most banks will tell you. Give us 2 years of tax returns. We're going to average your income because your income could be high one month, low the next. We're going to average your income and qualify you off of that. There are many cases where you can get by with just 12 months. So 1 year of business if things look good. So just know that you don't have to wait the 2 years. There are exceptions to that. But once you have at least 12 months, you should, and you're interested in homeownership, you should definitely talk to a lender about getting pre-qualified. All right. So again, just know there's a lot of programs. It's, we're not going to go into the weeds of each one of these because every market's different. You guys from all over the country on here, but just know that there's a lot of cities and counties and states that have programs to help you get into homeownership. And a federal program that's really good for Native Americans is the HUD 184 loan. This is the Indian Housing Loan Guarantee. This is very similar to an FHA loan, except for there's a little extra benefits that make it slightly sharper, slightly better in some areas versus an FHA loan. So FHA is anyone in America. You don't have to be a first-time home buyer. You just have to live in the house. You can buy a home with federal insurance behind it with only putting down 3.5%. However, the 184 loan, there's no income caps to it. You only have to do 2.5%, so you actually save a percentage point. There are a lot of tribes will have assistance programs with it. That loan limit's now also increased. So in Pima County, it's now went from 420 to 472. So it's a great product. The one thing that is a little bit different from FHA is because it's less money down and because the mortgage insurance is cheaper, they are a little bit tougher about credit stuff. They don't want to see like an outstanding collection. They want to make sure that if you're currently paying rent, that the mortgage payment's not like a huge difference, huge shock above what you're paying in rent. And if it is, they want to make sure that you have a little bit of money saved, kind of set aside to show that you can handle the difference in increased payment. But overall, the 184 will get you into a house with less down. A lot of times the tribe will offer some type of incentive, and you're going to have a lower monthly payment because the mortgage insurance is less expensive. I think these are, you touched a little bit on this, Amit, about the down payment assistance and how it can work. There are some that are just straight up grants, state money that when you buy the house, that money, as long as you qualified, it's yours, no strings attached. If you sold that house in 10 months and they had just happened to give you $10,000 to buy that house, you're essentially walking away with that money 10 months later, because when you sell it, whatever that house is worth, you're able to sell it and take away any difference after the bank loan is paid off. So that's a true grant. Then you have forgivable loans, which is what Amit and I discussed, where maybe after 5 years, you don't have to pay it back, or 3 years or 10 years, it's completely forgiven. And then you can have some that will have deferred or low interest, where maybe you wait a while before you make a payment, or maybe there's a very small payment that is owed monthly. So those are different ways that you see assistance given to you. The most popular ones that I see are the first two. It's either a straight up grant where it's just, here's the free money, you qualify, or a forgivable loan where don't worry about paying us monthly, but if you try to sell the house too soon, you're going to pay us back. But after you wait the 5 years or 7 years, it's yours to keep. So just know that most markets have some type of option like that. To give you an example, I showed you a slide earlier. This shows like how one would qualify just in my city. These are all the different programs that are available just to help people get into a house. And you can see the different restrictions or whatnot. Again, I'm not going to spend a ton of time on this. I just want you to see it and know that, I mean, just in my city alone, I have, these 7 options to pick from. So in order to get into a house, though, I think we need to have a basic understanding of credit and how it works, because whether you buy real estate or not, this is going to affect you and follow you your whole life. And I see 2 different viewpoints on credit, and I hope that I can influence everyone on this call to jump into the category that you should be in versus the category that some people are in that hurts them, which is some people have a viewpoint on credit of, I don't want to be in the credit system. I don't want to have credit cards. I'm just cash only. And that's going to be my mindset, is cash only. The problem with that is it's going to affect you financially in so many different ways, and life will be more expensive when you're just cash only. And why do I say that? Your insurance is quoted and rates are given to you based on credit. Jobs are granted to you based on credit. Auto loans, student loans, mortgages are based on credit. So if you are cash only basis, your credit score is going to be lower or non-existent. And so therefore you're going to pay more in every one of those categories, or you're going to cost yourself opportunities. So this algorithm, this pie chart here, I'm going to simplify credit to such an easy recipe that everyone can follow. The US wants you to be a consumer. They want you to have debt. They want you to use credit cards. And you're incentivized with the scoring system to be a consumer. That does not mean that you have to owe thousands of dollars of credit card debt. That does not mean that you have to pay 20% interest on a credit card. But what it does mean is that you should use credit cards, and you should use credit cards to benefit you versus letting credit cards use you to benefit them. A couple of years ago, I went on an amazing trip. I went to Thailand, Hong Kong, all that, completely paid for by my American Express card. My plane ticket, my hotels, my transportation, all paid for by my credit card using points. How can my credit card company afford to do that? The reason why is because I use it for everything. I don't use cash. I use my credit card. Then I pay it off every single month with my cash. So I pay 0 in interest. And the credit card companies know that there's so many other people that are going to carry credit card debt, and they're going to pay 20% on their credit cards. And they can make so much money off that 20% that they can advertise other clients to, hey, come use this credit card. We're going to give you 5 times points in your gas. We're going to give you 2 times points in your groceries. And you can grow those points so much. And as long as you pay it off every month, you pay 0 interest, you can use those points to cash in for flights and many other things. But, what are the easy recipes to take out of having good credit? Get 2 credit cards. Use one for gas, use one for groceries, pay them off every single month. You will pay $0 in interest. You don't need student loans. You don't need auto loans. You don't need mortgages. Just those 2 credit cards will give you a credit score above 740, which is, A+ in the US, and everything will be cheaper for you. Your car payments, your insurance payments, your mortgage payments, everything will be cheaper because you have a good credit score. Now, why does that plan work so well? Well, when you have 2 cards, once you have them open for 12 months or longer, they are considered weighted. So you get this 15% boost because they're considered reputable. It's not like an account I opened yesterday. I've had this account for a year. I paid on time for a year, so I get bonus there. I have my payment history. If I paid on time, I get 35% of my scores based on managing my payments on time. And then another 30% is making sure that I'm not maxed out. The mistake that people make with credit cards is they carry debt. Now you're paying 20% on it. And if I get approved for $1,000 Disneyland card and I go spend $900 on it, I'm so close to the limit that I actually lose points. So you want to stay below 30%. I'd like you to be 0, so you pay no interest. But if you have to carry a balance, pay it below 30% before you go apply for a mortgage, before you apply for a car, because that's going to give you a better score. So just those two things, 2 credit cards, pay them off every month, or at least get them below 30%. You don't need anything else. You will have good credit. If you're going to replace a card, if you're going to get a new card that has a lower interest rate or something, keep your second card for at least a year before you close it out. That way you always have that history of at least 12 months or longer. So that's credit in a nutshell. Easy way to make sure that you maximize over a 700 credit score.
So Derek just gave you a couple pointers there that, like there's a lot of things on the internet on how to increase your credit score. What he said, getting 2 credit cards, and there's a lot of free credit cards out there. So that doesn't mean you have to go out and get, a card that has a $300 annual fee. I mean, just go to your local bank and get a credit card that's free. Because we did have a couple of questions in the chat about, how can we increase our credit score? So he just gave you a pretty bulletproof formula right there that everyone buys food, everyone gets gas. So just go through that. It's not going to happen overnight. It's going to take a little bit of time. And then when you call a lender like Derek, one of the first things that they do is they will, Derek, do you want to talk a little bit about, how you pull credit when someone calls? And
yeah, and so if you notice this is kind of your easy plan for credit, right? So get your cards, keep your balances, low, pay your bills on time. And if you have had mistakes, if you have things like, hey, I'm trying to build my score, I had old collections. The biggest mistake that people make that I see when they're getting ready to buy a house is they go start paying the sins of their past. 5 years ago, I had these collections. They're 5 years old. Paying it today will usually make things worse, not better, because it's going to have to put today's date on it if you pay it off today. And if it's 5 years old, it's so minuscule on the impact on your score. The thing that most people don't do is they don't reestablish credit. So if you made a mistake in the past, the best thing that you can do is go get new credit cards today. If you're like, well, I messed up my credit so much, they won't even approve me. Go get a secured card. That's where you give them $300. They give you a card worth $300. If you don't pay them back, they're going to take your $300 and not refund it back to you. You could file for bankruptcy today and get a secured card tomorrow. I've seen people 1 year out of bankruptcy have a 700 credit score. I've seen people 5 years out of bankruptcy and they still have the person that rebuilt their credit to 700, they went and got like 2 credit cards the day after bankruptcy, and they followed the plan that I gave you. The people that 5 years later still have a bad score is they went to the cash only method. And so the only thing on file for them is the mistakes of their past. Credit looks more at what you're doing right now in the most recent 6 months than what you did 12 months ago, 18 months ago, 24 months ago. So the older stuff matters much less than what you're doing today. Now, in respect for time, I think that we've covered a lot on like the finances and loan programs. So Amit, I will, we have some things about rent and all that. I'm just going to stop here and let you kind of talk about the basics of homeownership. And I think I'll take you to that slide. So let's move over there.
Sure.
So I think probably a good thing to touch on is the equity portion. So we touched a little bit on that. So you want to talk about this a little bit?
Which one?
About just the forecast over the next 5 years, kind of how you view housing.
Yeah. So, I mean, again, real estate is very regional, right? So there's, like when you really have to know which community. So when I was living in Gallup, New Mexico, I mean, all markets appreciate in the long term, but like Gallup is not going to appreciate at the same level like an Albuquerque or a Tucson or even a Phoenix. Phoenix has seen pretty meteoric rise. Tucson is still on its way up, but so each market is regional. So you really need to work with someone who's got some experience in that market. But overall, real estate's always a smart bet. In the long run, it's going to appreciate over time. So, I mean, Derek's given you some good indicators in terms of, like inventory being low. We've heard people saying, I'm going to wait for prices to crash and then I'll buy a house. And how can you expect prices to crash when we have literally millions of fewer homes for sale than there is demand for homes? Which chart are we going to be looking at here, Derek?
Yeah, so just closing out, we have the buy versus rental. And I think that there's a lot of math that goes into this. We look at the rent rate, we look at renter's insurance, we look at over time, when you're saving money on rent initially, and then rent continues to increase. the nice thing about a mortgage is it gets locked in. And so over time you start saving, and then you also get the benefit of appreciation, tax benefits. So in this example, we took where rents were actually lower than a mortgage, and then we just forecasted it out 10 years on an average home in Pima County, which our sales price on average is $350. And the difference over 10 years was $189,000. And that's why I love this stat. I'll take you here so you can see that I put it in the slide, and you guys can just Google this yourself. Average net worth of homeowner versus renter. And I had that in the slide earlier. And you can see how many CNBC, Ruby, keeping current, this all comes from the Federal Reserve. So you can see that 40 times higher net worth. So Amit, I'll kind of throw it back to you to close out. So we've given a lot of the education about credit, about these programs, about down payment assistance. And let's say that I'm a buyer and I get qualified. I talk to Derek or somebody in another state that's a lender that can qualify them, and I find out I'm approved. How does that then translate into talking to the realtor? What happens next?
Okay, so what we like to do is we like to have, like I really like to work with buyers who have done a little bit of homework in terms of figuring out their financing piece. Once they know their financing piece, what I do is I usually set a buyer, and any realtor that's knowledgeable will do this, but I set them up on a search. So they'll say, okay, hey, I'm qualified up to 350. These are my criteria. I want a home single story, this many square feet, this much, this part of town. What I'll do is I'll go into our multiple listing system and I'll set up a geographic search that meets their criteria. That way the buyer, because the market's still fairly competitive. I mean, it's not as crazy as it was a couple of years ago, but I want my buyers, as soon as a home hits the market that meets their criteria, I want them to automatically get an email. I don't want my buyers to have to go on Zillow and find the home that they want. I want those listings to automatically go to them. So in our system, I can set up a buyer for an automated search. That way they're getting listings every single day that meet their criteria. Once something hits the market that they like, we go check it out. And then the purchase contracts, pretty similar overall, but each state has its own nuances in what goes in there. But we write a purchase contract. There's some strategies that I've put in to have offers be accepted. My last first-time buyer, we got her offer accepted over 2 cash offers because we did a couple things, and here's what they were. We put in an appraisal shortfall, so she had to go a little bit over, not a lot, but she had to go a little bit over, and she put in the contract that I'm willing to pay out of pocket up to $20,000 if the appraisal doesn't come in at value. So obviously with the cash buyer, the seller doesn't have to worry about that because they're not going to have an appraisal. In her situation, she put that in, and the appraisal did come in a little bit low, so they were covered there. We shortened the inspection window. So she said, I'm going to get all my inspections done within 4 days. So we're not going to waste the seller's time. We're going to get in there, we're going to inspect the property. And we didn't really even, there was a couple small things that we negotiated, and we offered a quick close as well. So we closed that loan in 15 days, which is about as fast as a cash deal can close. So again, each person's situation is a little bit different. I think the best thing to do, and we've gotten some feedback in the comments here, is that people, if you want to reach out to us and talk to us about your specific situation, but I think what's really important the first thing to do is really understand what your numbers look like. So to that effect, it's really important to talk to a lender, because if you come to me and say, I want to buy a house, there's thousands of homes in Tucson. It's hard for me to steer you somewhere without knowing what you can afford. And like Derek said, sometimes people don't realize that they're ready for homeownership. Now, on the flip side, sometimes people are a little overconfident. They think they can afford much more home than they can. So that's not my place to decide. That's really a conversation between you and the lender. Once you have those numbers solidified, then we can really hit the ground running and go from there. So, and then one more thing, Derek, we did have some questions from the beginning that I thought were good and I wanted to get to. So I wanted to, let me circle back here.
Yeah. And I was just looking at the chat. So while you're digging out the first question you want to ask, let's just kind of wrap all this up.
Yeah.
So wherever you're at, obviously I'm biased. I'm very bullish on real estate. The data to me just makes it very clear. There's nothing better that you can do in your life than own your own primary home. Whether you want to build strip malls or multi-unit apartments or commercial buildings or whatever else, that's a whole different game. I think everybody should aspire to at least own their own home. You saw that stat there about net worth. It's a lot easier than people think. If you have less than perfect credit, that doesn't mean that you should not be a homeowner. If you've stumbled along the way with credit, don't beat yourself up. It's very easy to fix. If you haven't started yet in building your credit, it's very easy to build. So know that as a country, we want Americans to own real estate. And there's many programs the federal government has created to make it easier for you to own real estate. And specific to this call, if you're looking at options to use tribal benefits, there's even additional programs to make it easier for you. So that, that's wrapping a bow on everything. Start with a lender, start with a plan. Doesn't matter if you're 12 months or 2 years out. It's never too soon to be educated. It just means that you have a longer runway to take off. So with that being said, let's go ahead and do some Q&A, and then we'll get you guys out of here. What questions do you want to address?
And then again, if anyone needs to leave right now, our contact information will be shared. Please reach out. We did this last semester as well, and I actually did a couple of Zoom calls directly with people afterwards to talk about their specific situation, and Derek can do the same thing as well. So if anyone needs to leave, we do want to spend a few minutes here to go over some questions, but please reach out if you had a specific scenario you wanted to talk to about. So Derek, let's talk about down payment. One of the first questions was, we plan on building soon. We have a large down payment. Would it matter to put down more, or should we just put down what they suggest? So what's your opinion on down payment?
I think that you should put down as much as you need to get a payment that you're comfortable with, and then put your money into other places. The reason why I say that is, even today with mortgages, the national average for a mortgage rate is about 6.3%. But for example, if you have an option to invest in your 401k or your IRA, the average return on S&P 500 is over 10%. So why would I want to pay off a 6% mortgage when I can make 10 or 11% in the market? I'll show you guys something that's actually pretty mind-blowing, because it's one thing for me to say it. Let me actually put the math on the table. When people are like, I'm going to pay my mortgage off early, I'm like, oh, why would you do that? Now, if you're above 50 and you're trying to get ready for retirement, different answer. For most of us that are buying houses in our 20s, 30s, and 40s, putting too much down will actually hurt you if you're just measuring finances. So there is a
and then Derek, you might need to share your screen again when you're ready, because
yeah, I'm pulling this up. There is a calculator that you guys can all have access to. It's put together by the Security Exchange Commission. So investor.gov, this is a federally endorsed website. And let's just say that I had a goal to pay off my house early. So let's just say I was buying a house for, we'll just use the national average right now is just under 400,000. So let's just say that I want to do a minimum down of 5% versus, let's say, putting down 50%. So 5% of 400,000 would be 20 grand. So if I only put down 20 grand versus 50%, which would be 200,000, that would save me $150,000. And again, this question was because they said I have a large down payment. And let's just say that instead of paying extra, your cost per thousand today is about $6. So if I'm looking at taking out a loan for 200,000 or 210,000, my difference between $10,000 is only about $60 a month. Okay. So let's just say that I saved the 150 grand because I didn't put down 50%. I only put down my 5. And let's just say that the client also says, we want to pay extra. We want to do a 15-year loan, and we want to put an extra $800 a month on my mortgage payment. So let's instead put 800 here, and let's just say that they did this for 30 years. The interest rate, the S&P 500 is averaged 11.8%, but we're just going to say 10, and we're going to do a 3% variance, which means that some years it might only make 7%, other years it might make as much as 13. And let's go ahead and calculate that monthly. So this just shows you over the course of 30 years, putting that 150 grand, instead of it putting it into the mortgage, you put it into an investment account where you got what is really a safe rate of return. So look at this. What is the S&P 500 average rate of return? You'll see that these numbers, this is just buying the 500 biggest companies in America. You'll see that these numbers are that 10% I gave you is actually highly attainable. This is the average, again, has been almost 11% for the last 30 years. Okay. So if I'm doing that, instead of putting it in my bank account, getting no interest, and I could buy that house at 400,000, 30 years from now, that house would be paid off and I'd have 4 million versus that person who's trying to spend extra, pay the mortgage off early. So I'm a big fan of put down as much money as you need to get the payment that you can live with, and then invest every penny. You're going to get 3 to 5 times better return than you are paying off a low fixed debt that's never going to change. So a lot of people, I think, make a mistake of trying to pay their house off too soon, and it costs them so much money they can't even fathom.
Right. So that's a good conversation about opportunity cost, right? What else can you
Yeah.
be doing with that money? And
Yeah.
and what Derek can do is, if they can reverse engineer for you. So if you say, I want my payment to be around this, well, they can say, okay, well, then you should put this much down. And that's something that they can very easily do. So if you have a specific scenario where you want your monthly payment, it can't be more than 1,500. And again, remember, your mortgage payment also includes property tax and insurance. And if your community has an HOA, all that has to be factored into your payment. So when I said sometimes people don't understand how much they can afford, sometimes people can afford more than what they think. And sometimes people don't realize that you also have to consider those. So again, they can talk to you specifically about what that would be. So that's a great point there, Derek. So question here was about assumable mortgages. And this is something I can talk to you about a little bit, because I've actually found a lot of success in this past couple of months. I've closed 2 assumable mortgages. I have 2 more under contract right now. So if you're wondering what an assumable mortgage is, certain loan programs, the government backed one, so it's FHA and VA, those loans can be assumed. So that means that a seller can basically let the buyer take over their current loan at the current term. So rather than getting a new 15 or 30-year mortgage, let's say someone had a 30-year mortgage, 2 years into it, they want to sell their home and had an FHA loan. The buyer can basically take over that loan at a 28-year term because the seller's already paid the first 2 years. Now, what's the caveat? Instead of putting a down payment, your down payment's going to be the difference between how much they want for the house and how much they owe on the loan, how much the principal is. The challenge with some of these assumable loans is, and what I'm seeing is that oftentimes the gap is pretty significant. So you're really not going to find an assumable loan where the gap is only like 3%. It's usually going to be the ones that I've done, the gap was like $50,000 to $80,000. So you have to have some cash. What's the plus is that you can take over a phenomenal interest rate. So I worked with 2 investors last month. They both got investment properties at 2.8 and one was at 2.6% rate for an investment property. Again, the downside was that they had to bring in more cash, which they had. So they were happy to pay that cash to get that interest rate. Now, if you have a conventional mortgage, those are not assumable. So most mortgages are conventional. Those cannot be assumed. So an FHA or a VA loan, if you can find the right deal, and I actually, for my own buyers, I have filters set up where every day I get a list. Anytime a home hits the market that has a tag for assumable loan, I get that. I call that listing agent. I understand the terms of that deal. And if I feel like I have a buyer who would be interested in that, I call them right away. And that's how I'm getting some success with those. So it is a longer process. The fastest assumable loan has taken about 2 months. Right now, we have one with PennyMac, and they're saying it's going to take 3 to 4 months because these have gained popularity in this high interest environment. So I think the corporate assumptions departments are a little backed up with those. So whereas, Derek can close a loan in 2 weeks, with a new loan, an assumable loan could take a little bit longer. A lot of times sellers don't like the idea that they're going to have their home tied up for 3-4 months to close. So it is hard to find, but it's not impossible, and you can potentially get a really good deal. So Derek, is there anything?
Emphasize what you said too about the gap too, that you're going to take over the old loan and you're going to have to bring in the cash to give the sellers the difference of what they're selling their house for. They bought that house for 200, now they're selling it for 300. You're going to have to give them that 100,000 to take over the $200,000 loan that they have.
Right. So it's a good opportunity. But again, whereas with FHA, you can put 3.5% down. I don't think I've ever, I don't think there's an assumable loan out there where you can put that little money down, because that means they basically bought it last month and they're selling it right now, So it's in most assumable loans, there's a pretty wide gap there. So they're out there. And if you have any questions about them, I'd be happy to answer any more besides, what I just went over there. So let me filter through here and see if there's anything else. So we did have a couple of people ask about the down payment assistance and grant programs. So again, email us about those. And, we can, especially if you're in Arizona or New Mexico, we can get you some information on that. In other states, what we can do is we can connect you with loan officers and realtors in that area who would be more familiar with the local programs there.
Yeah.
Okay, let's see. Derek, a couple of people had asked about building on tribal lease land, with the HUD program. Do you have any experience with that, or would they have to work with a special bank, or is that something that you guys?
Yeah, so I know it is possible because we have a few of that here in town. But as far as doing it with the 184, I don't believe that you can do that, but I'm going to double check that. That was a good takeaway. I saw that too.
Yep.
So I will find out if you can do construction financing specific 184 on leased land.
Right. Okay.
I'll get that to Loyola.
Okay, here's a good question. Is it beneficial to buy a condo or apartment if you can't afford a home in the market? Derek, what's your opinion on condos? Let's say condos and townhomes.
Yeah, so I think that again, if it's a payment that you can afford and it's a property that you like, condos are a great solution. In big cities, condos are, you know, Chicago, California, LA, many people buy condos as they're starting real estate, and you still own it. So that's the nice thing about it. The only thing I would caution you with a condo is just remember that your condo your neighbors affect your ability to sell and buy in a condo. As an example, if you buy in a project that is poorly capitalized, let's say a developer doesn't really know what they're doing, then that's where you could end up getting into an issue where the HOA is not being paid for, therefore the community pool is not working. Now, that's going to be very rare to happen because on the lending side, we're going to do research up front to make sure that you don't get stuck with a bad investment. That's where you hear the term warrantable condo. So that the only downside for a condo is if you bought some undercapitalized, something that has issues, that's very rare. I think condos are a great way to start owning real estate. And a lot of times people started with a condo, they improve their life financially, they buy a house 5 years later, and they keep that condo and turn it into a rental. I've seen many condos turn into great investment opportunities.
Yep. So when you're buying a condo, what's really important is to make sure, or a townhome, when you're buying a property, the title company within the first week or so will send you like a title commitment, and then they'll also send you all the HOA documents. So especially with a condo or a townhome, because their restrictions are much more onerous than like a subdivision, like a single family home is. So they have many more restrictions on like, you know, what kind of, most condos you can't Airbnb them. So you really want to understand what you're getting into. You also want to do your due diligence and look at the financials of the condo. Like Derek said, on the lending side, they're very cautious about looking and making sure that the condo HOA has enough money in reserves. But I have friends who bought condos and then 10 years later, they said like, oops, we didn't take great care of the common areas. Now we're going to levy a $20,000 assessment to every single owner in this complex. And you can't say no to it because you're already part of that HOA. Now it makes it very hard for them to sell that condo to the next person, because the next person is buying a condo with the knowledge that they're going to have to, this like $20,000 additional levy that they're going to have to pay for so that the condo can pool enough money together to get these repairs done. So you just want to do your due diligence. You want to make sure they have enough money in reserve, that they've taken good care of the common areas. But again, like in Tucson, you can get a condo for like under $100,000, easily. So in terms of getting a first place to get, that's definitely an option.
Perfect.
Okay, let me see if we have anything else here.
What I saw, I think we touched on. There was one thing about credit. So we touched on a little bit. Just again, remember that the consolidation, a lot of times I would tell you, try to do your own consolidation versus hiring a company. Somebody mentioned getting ripped off on there, and a lot of people will do that. They will charge you a fee just to go dispute everything. And if that means that your credit score will temporarily increase for 1 to 2 months, because once you dispute it, it doesn't count in your score. So if they dispute 5 negative things, it's almost like it disappeared. But once those companies prove, nope, this really was Derek's medical collection, then that dispute gets removed and my score goes back down. So a lot of times you just got to be careful. A lot of times you can make those phone calls yourself, work it out yourself. That way you don't have a middle company, a middleman charging you a fee for doing temporary work that didn't really stick.
Yep. And then let's end on one more observation I saw in the comments, because I don't see any more questions coming in here. So a couple of people talked about doing home improvements and adding value to their house. So let's talk a little bit about that. So there's a couple of things, when you own a home, the nice thing is the home will appreciate over time on its own, but you can also do what's called forced appreciation. So you can add value to the house yourself, either hiring a contractor or doing the work yourself. Derek, what are some ways, without selling your house, how can someone, when they've done some renovations to the property, how can someone tap into that extra appreciation?
Tap in or add to it?
Oh, tap in, like maybe you can talk about like HELOCs and cash out.
Okay.
Yeah.
So piggyback, I think that's another nice thing about real estate. Again, if I'm buying stock, I'm hoping that the company makes good choices and it goes up in value. When I own the real estate, I could change out the doors, I could change the paint, I could coat the roof, I can upgrade the bathroom, I can upgrade the kitchen, and those add value. also over time, real estate grows in value. Now, let's say I bought a house 5 years ago. Today, it's worth $200,000 more, and I want to tap into that equity to, maybe do an addition on the porch, or maybe I want to use it to buy a boat. Technically, it's your equity. You can do whatever you want to do. There's ways that you can pull that money out through things like a home equity line of credit, where a bank will say, hey, we'll give you, 80% of what your home's worth. We'll give you that as a line of credit. It's kind of like a credit card, but against your house. And because it's against your house, unlike a credit card where you're paying 20% interest, those rates are 3% interest or 5%. Today, the rate's like 8% interest. So you can get a line of credit at much lower rates than you'd pay on a credit card.
Right. Just to give you a scenario of something I did. So I had a few rental properties in Gallup, and I bought them initially at like close to 6% interest rates. A couple of years ago, rates just bottomed out, and I was able to do what's called a cash out refinance. So I kept the property. I had an appraiser come out. They valued the property. I had done some repairs to all the properties, so they had gone up in value. So I was basically able to take that extra cash out, and that's cash to me. Since I'm taking on debt, it's not a capital gain, so I'm not taxed on the extra cash that I got out. My rates, I refinanced my rate from 6 to 3% through a local credit union. So my payments actually went down. So across all 3 properties, my monthly payment was actually lower than what it was before. And I was able to pull out $80,000 in extra cash. I use that $80,000 in cash to just buy another home straight up with cash. Now I have an equity line of credit against that home that I can use for renovations on my other properties. So, that was just like really, really good timing. I don't think rates will drop down to 3% for investment properties again. But just to give you an idea, I didn't have to give up any of my properties. That was the thing. I had them, I added some value. I was able to retain them. I'm just waiting for the cyclical interest rates to come down, and then I can pull out cash if I need to. So that's the beauty of having real estate, is once you have it, there's a lot of things you can do to it without necessarily having to give it up.
Yeah. Well, I want to thank everybody for their time. I know there's some questions about recording and whatnot. Loyola, do you want to touch on that?
No, I just wanted to say thank you all so much for being here and, lending your expertise and your story and sharing that with our scholars and with our attendees tonight. I deeply appreciate it. Please do complete the event evaluation. In it, it asks for your email, so I will send a recording to those who have put in their email addresses, as well as Amit and Derek's contact information. Once again, thank you all so much for being here.
Thank you very much.
Thank you for your time. Yeah. Thanks.
Wish you guys all the best in your journey for homeownership. Take care.
All right. See you guys.
Bye.